Right now in 2022, we are experiencing a rare event that economists call stagflation. What is stagflation, you may ask? Stagflation is a period of time in which the American consumer is experiencing high levels of inflation alongside slowing economic activity. This situation has the potential to be catastrophic to the markets, and in this video, we'll be revealing how bad things could get and how traders and investors can be better informed for the market moves ahead. For reference, we need to go back to 2020, when we experienced something unprecedented. During that time, the Fed printed more money than ever before to paper over the businesses and consumers who were hurt by nationwide lockdowns. Temporarily, the money printing made things look pretty good. But despite the Fed's constant reassurance that inflation caused by stimulus would be transitory, we've seen numbers climb to levels we haven't seen since the 70s and 80s.
Prices up in April from a year ago, 8.3%. That is still a 40-year high, though it is a lower pace than what we saw in March, where prices were up 8.5%.
So how did this play out last time? Well, it wasn't pretty. But in this video, we'll give our best predictions based off history, charts, and data. Remember to subscribe to A1 Trading and leave a comment down below if you enjoy this style of content from us, and we'll make sure to keep it coming. Last quarter, the US economy shrank by 1.5%, but inflation rate has peaked out recently at about 8.3%, and this is probably not foreign to many of you listening. Have you been to the gas pump recently? How about the grocery store? You may have noticed things looking a little bit different lately at the checkout line. As you can probably imagine, this hurts consumers big time, and you can see why we may have a serious problem on our hands. Businesses are under a lot of pressure to raise wages in order to stay competitive in what has been a very competitive hiring space in recent years, but they're struggling to do so given the decrease in consumer activity and shrinking revenues. We've seen this across the board on average in the most recent stock market earnings sessions. So, as traders and investors, what's the next best move? If we know that there are major headwinds for the markets right now, is it best to stay out of the markets altogether? Or are there some trends that we could take advantage of? Well, we think the answer lies in history. Here's what happened the last time we experienced these high levels of inflation. In the 1980s, we saw a very similar situation in the commodities market. Oil prices were on the rise, and the monetary policy was struggling to keep up. As you may or may not know, generally, a rise in oil prices due to low supply can cause people to pay more at the pumps, which hurts the consumer. They spend less and save money, and that leads to businesses underperforming. Sound familiar? Sometimes you'll hear people claim that history repeats itself, which is not always exactly right. In our view, though, history does tend to rhyme. So what happened next in the 80s? Well, rising unemployment numbers began to roll in as consumer spending was hurt by high prices. With companies seeing their top line shrink, more and more they began to lay off their employees. Here's a scary stat for you. By the summer of 1980, inflation was near 14.5% and unemployment was just over 7.5%. Fast forward to today, we're still sitting around 3.5% unemployment in the US. We think that if the commodity markets stay red hot for the remainder of 2022, there's a good chance we could see the unemployment rates creep up. That in turn could be very ugly for the US dollar and could slow the Fed's recent hawkish tone. We'll talk more about the US dollar in a moment. With the recent slowing of company revenues in the States, we think there are many signs showing that there could be rocky roads ahead. So now the big question, what do we do with all this information? Here's our next big moves at A1 Trading. For those of you who don't already know our team, we're a trading and research firm in Atlanta, Georgia, and we've been doing more than ever to try and prepare for the storm ahead of us in the financial markets. Of course, we should take a pause for a moment to remind you all that this video is not financial advice and that these are purely our analysts' opinions. Short term, we have a semi-bearish to neutral outlook on the stock market. Looking at the chart, you can see this year that things have been pretty decimated already, especially tech stocks, which have been crushed by rising interest rates that put pressure on their debt situation.
Uber shares down 45% year to date. Netflix, Amazon, Meta, all down more than 30%. And the question looming over the entire sector is really, who will be the first to make some drastic cuts?
At our firm, we tend to avoid shorting the stock market, but there are definitely some currencies and commodities that look attractive to us in the coming weeks and months. Let's talk about a big one, gold. Looking at gold back in the 80s, the price soared dramatically off fears of surrounding inflation. If history even remotely rhymes, we think gold breakouts to the upside have a nice potential of going far. Here's what we'll be looking out for. Key structure breaks, retests, and continuation patterns with relatively tight stops. One thing to note, we would really like to see some signs of the trend picking up speed prior to looking for entries. Our team focuses very heavily on momentum-based trading, especially in a market like this with such high volatility. We've been able to catch some pretty great trades. Take a look at one of our recent trades on the dollar-yen pair. This trade was taken by our head trader, 𝗀𝗂𝗯𝗀𝗀𝗰𝗍𝗂. With the rising US 10-year chart, Nick went with the trend and was able to capture a really impressive runner on this pair. Our team at A1 Trading does an immense amount of research and shares their trades live every day inside of our private subscription service. If you'd be interested in getting a notification anytime we take a trade, please consider subscribing to our service in the description below. We trade things like gold, the US indices, major currency pairs, and much more. For our YouTube subscribers, we're currently doing a major discount price when you use the code A1YT at checkout. We do also offer a chat room and extensive education material as well. Make sure to use the link below, and we hope to catch you inside the chat room soon. Speaking about 3 to 6 months out, we think equities will still be struggling or neutral, and we think our gold idea could be coming to fruition. Should we be correct on our bullish bias on gold, we will likely look to cool the jets on our buying and let the winners run. Again, this is assuming we are correct about our outlooks. Going back to the dollar-yen pair, here's what our analyst Michael Donahue had to say about the pair. Quote, Japan's economy is in a relatively unique situation compared to the US. At first glance, there appear to be many bearish fundamental indications for the dollar-yen pair. Japan's unemployment rate is an impressive 2.5% compared to the 3.6% in the US. Inflation has been climbing consecutively month over month, and the quarter-on-quarter GDP contraction in Japan was 0.2%, far less worrisome than the 1.5% contraction in the US. End quote. However, this information is all secondary in light of the Federal Reserve's hawkishness as they pursue tight monetary policy through steadily raising benchmark interest rates to cool the overheated US economy, where year-over-year inflation is currently 8.3%. The Bank of Japan, on the other hand, is continuing their ultra-loose monetary policy strategy. They are keeping their key short-term interest rate negative as year-over-year inflation clocks in at a tolerable 2.5%. We think the dollar-yen pair buys on a pullback could be a very profitable play, so long as their pair continues to produce a nice trending environment. Onto another major pair that we haven't talked about yet, US oil. Because the commodity market is so hot right now, we will probably be doing a separate video on oil itself in the near future. We recommend subscribing to the channel if you'd like to see that video soon. So, oil for us is innocent until proven guilty. In other words, it's trending well, and is a buy until the trend is no longer working out well. With Russia's invasion of Ukraine and the supply line issues that have arisen alongside that situation, oil has been soaring for months. Like many times throughout history, we believe this shortage could continue much longer than people expect. We will be constantly looking for pullbacks on the commodity itself, as well as currencies that are positively correlated to the rising oil prices. Speaking of which, the Canadian dollar comes to mind. The Canadian economy is strongly correlated to the oil market due to their large export of oil. We have been bullish on the Canadian dollar for several months and believe that it has more upside to come. We'll be looking to trade the Canadian dollar pair in currency crosses like USD CAD, CAD JPY, and Euro CAD inside our trading firm. We promised to discuss the US dollar, so let's take a moment to follow up on that. The US dollar is off to a very strong start in 2022, but we have our doubts on how long it will last. With our previously mentioned concern about the potential of rising unemployment and layoffs, we think the Fed could potentially soften its tone on monetary policy, which could act to cool the dollar. We have been looking for opportunities to be short bias on the dollar, and we plan on keeping you updated on the channel. Markets in 2022 are incredibly volatile and heating up fast. Here on the channel, we'll continue to share everything we know about the markets totally free of cost. A big shout out to our premium Discord members who help make our content team's work possible. And if you've been thinking about joining our premium services yourself, remember to take advantage of the majorly discounted prices when you use code A1YT at checkout. Have a great day.